by Global X ETFs.
Welcome to Barron's Roundtable, where we get behind the headlines and prepare you for the week ahead. I'm Jack Otter. Coming up, inflation remains stubborn, leaving the Federal Reserve stuck on hold. Corient partner Andy Capron tells us what higher for longer interest rates means for your money. Then we've got our latest big money poll out of professional investors. Barron's senior writer Paul LaMonica will dive into what managers are bullish on, bearish on, and why earnings growth is lower than you probably thought. And later, American automakers had a much better earnings season than their European counterparts. But we begin with our expert panel and three things investors ought to be thinking about right now. On the Barron's Roundtable, my colleagues Ben Levison, Megan Leonard, and Al Root. So, Ben, it was not a great week in the market, and then we got this, should we call it a Goldilocks jobs number that pleased everybody?
Yeah, I mean, it was a really decent number. I mean, at first glance, it disappointed, but it was still 175,000 jobs, which is it's a pretty nice number under most conditions. And then you look at wages, average hourly earnings, they went up, but it was pretty benign. And everybody, all of a sudden, the market is going up. Treasury yields are coming down. It was just the kind of thing they wanted, which is a real change from earlier in the week where it seemed like the market was able to freak out about just about everything. We had an employment cost index came out, the market dropped. There's a lot of selling going on at the close. It was just not a great market, but the tone completely changed by the end of the week.
Still, you saw some trading activity throughout that week that bothered you. Can you explain?
Well, it was weird because at the end of the day on Tuesday and Wednesday, the stock market dropped on both days 0.6% in the last 10 minutes. One day of that kind of drop in the last 10 minutes is rare, but to do it twice, that's only happened 10 times since 1985. And it usually happens in times of crisis. There happened 4 times during the financial crisis. It happened in 1987, happened during Volmageddon. I don't know if anyone remembers that in 2018. And this time there's no crisis, and the market's not even in a correction or anything. So it makes you wonder, is the market down enough for this to be a buying opportunity? But maybe that was the spate of selling that actually causes the market to go up from here.
So look at your crystal ball. What do you see next?
Well, I'm watching the 50-day moving average because, this is a technical indicator that really says what the short-term trend of the market is. Right now, we're below that 50-day moving average. We closed just below it on Friday. And I'd like to see us get above it. Until we get above that index on the S&P, that average on the S&P 500, I think you have to be a little nervous that the market might sell off again.
All righty. Al, I have a question for you.
Yes.
What do Meghan and Harry have in common with 3M?
I don't know. This is a surprise.
They're fallen aristocrats.
Oh, my goodness. That's genius. I'm going to use that at home. 3M has raised its dividend for 64 consecutive years. To be a dividend aristocrat, you have to... Man, I'm struggling to recover. You have to raise your dividend for 25 years. They announced the reset. They're cutting their dividend. The cut's not official, but the numbers they use imply they're going to cut their dividend by about 50%. So it's a sad day in the Root household. My kids care about these things, I promise. But it was a really good thing. The stock is up actually 6% on the week after announcing the cut. They have been dealing with tens of billions of legal liabilities over the past few years related to cleaning up these forever chemicals in people's water, related to potentially faulty earplugs sold to the government. So it amounts to really taking your medicine, and now people can sort of invest in the stock on a go-forward basis.
Oh, yeah, real quick. The Alphabet announced a dividend. Do you think Amazon should too?
I think we said late last year that Amazon, Google parent Alphabet, and Meta should all pay dividends. It's time. Google and Meta have made the leap, and we were hoping maybe with Amazon earnings they'd do it, but they didn't.
So, Megan, sometimes when you announce a dividend, that implies that the growth days are over. That is not the case with big tech, as we just saw.
No, and, it's interesting. This week was a weird one. I mean, we had Apple earnings, and, of course, investors were very happy with that massive $110 billion buyback. And obviously, that makes people happy. But interestingly, we still saw sales of the iPhone down 10% year over year. Revenues were down a little bit. And sales in China, while they were a little bit ahead of analysts' forecast, still less than a year ago. So there was some interesting things. Obviously, I think the news that everyone was watching for was AI. And Tim Cook didn't exactly deliver a ton of details there. But it is interesting. We are going to see a little bit of movement there. We're going to get the new iPads next week. And then I think they're going to get into the details at the Worldwide Developers Conference. And so hopefully we'll start to see some strategy around what Apple's doing with AI. It's interesting. My colleague Alex actually is really bullish on this. He was saying earlier this week that he thinks that Apple could be the next big AI winner because they are involved in so much of our daily lives.
He's been a long-term bull, and so far, so good. So AI is clearly part of the powering behind also Alphabet, Amazon, Microsoft. They're benefiting in their cloud services. In the chip maker department, it's part of the mix, but it's not always positive.
It's interesting. I think we had a lot of the chip makers announced this week. We certainly, saw some volatility there. I mean, you had folks
not quite
like
Volmageddon.
Not Volmageddon. But Advanced Micro Devices, AMD, you had Supermicro Computer, you had ON Semiconductor. All of them actually reported at the beginning of the week. And I think that they actually had some issues with some of that market headwinds that we saw a lot of stocks dealing with. But they have sort of bounced a little bit. AMD is a really interesting play because while it did beat on its earnings, investors really want to see a blockbuster quarter here. They didn't come away with a lot, but it was interesting. They did see some real growth in their data revenue services, or their data center revenue. There we go. So,
alrighty. Thank you for that. Rates expected to stay higher for longer, but weaker U.S. jobs data could soothe Fed worries of renewed overheating. Corient partner Andy Kaplan gives his outlook on the market and the impact of stalled inflation progress next. Jobs numbers coming in weaker than expected for April, missing expectations by 65,000. The economy adding 175,000 new jobs last month, while unemployment rose to 3.9%. Does this make the Fed's job a little easier? My next guest is predicting at most one rate cut coming from the Fed this year before the year's over. Joining me now is Andy Kaplan, a partner at Corient, an independent wealth advisory firm managing nearly $150 billion. A lot of growth over the years since I've been talking to you guys at Region Atlantic. So the mantra on Wall Street has been higher for longer. You've tweaked that a little bit, and you're saying later and less. What's the distinction?
Yeah. So here's the distinction. The first one is, I think when we entered this year, there was the expectation of a lot of Fed cuts, and also for them to be front-loaded or perhaps to start much sooner in the year. Even with
6 to 3 to 1.
Yeah, to now potentially none. Yep. My prediction is later in the sense that it's likely to happen all the way towards the end of the year. I think December is frankly the most likely because at some point as we start the summer, it gets too political for the Fed to do an about-face on monetary policy in the face of an election. So I feel like December is the most likely time frame. But my most important point is less. I think many investors are used to low interest rates, have not adjusted their idea of a terminal or normal Fed funds rate up from something like 0%. They might be anchoring to something like 2%. In my opinion, we're seeing a really tight economy that is naturally undersupplied, undersupplied with labor in particular. And I think it's possible that the terminal rate for Fed funds is something closer to 3.5%, maybe even 4%.
Which is kind of how it was decades ago.
Exactly.
Before the era of free money. So let's talk about tech investing. I'm sure your clients are clamoring for it. Hey, Andy, get me into this AI stuff. What do you tell them?
So what I tell them is, if you're a typical American investor, you already have AI in spades. If you're invested in the S&P 500, any large cap active management, you'll likely have the leaders in AI already present in your portfolio: NVIDIA, Microsoft, Google, among many others. They represent high double digits in a typical portfolio. So what I tell them is, you already have it. I don't think it's a bubble. And what I don't think you ought to do is look farther afield from the leaders. Here's why. One is, I view artificial intelligence as a super capital intensive endeavor. So the companies with the most free cash flow to throw at this and be able to take a few years to realize the profits of it are already those biggest ones that I mentioned.
Yeah, Amazon's adding more to its Anthropic investment.
Exactly.
And not everyone has $2.5 billion sitting around.
Yeah. And the other point I would make, and it's actually been to the benefit, I think, of U.S. investors, that the IPO market has been closed through all this AI frenzy. Why? Because usually the IPO market, in my view, sometimes incorporates a lot of speculative businesses that have a very long time to maturity. In this very high upfront cost market, I think it would be very hard for startups to really get their foot in the door and become dominant. So I think it's actually been to the benefit of investors that the IPO market's been closed. And my partial worry over the coming months is because of a bull market, because of us hitting highs with relatively low volatility, that starts to change and investors start to get exposed to some of those more speculative frenzies.
Bad news for the investment banks, but good news for your clients.
That's right.
Let's also talk about foreign investments. So we've always been saying, hey, you got to diversify overseas. Back in the aughts, it saved your portfolio. But recently, it looks like the S&P is actually where you want to be. Well, what's your take on that?
So a couple of really interesting points to make there. First of all, last year, 2023, I think a lot of people saw a really dominant U.S. stock market that outperformed other global averages, which is true, but here's a little rub. The average American stock did worse than the average developed ex-U.S. stock.
Wow.
And it was all about the AI, it was all about the Mag 7 in the U.S. driving a higher index average. So ex-US stocks are doing well. It's just getting lost in the shuffle. The other point I would make is I think a lot of investors are used to thinking about international developed markets as banks, insurance companies, oil producers, low profit margin, commoditized businesses. I don't think that's the case anymore. Largest business in Western Europe is a company that makes weight loss drugs. Some of the largest producers of components for the AI revolution, the semiconductor manufacturers, are based abroad in Taiwan, Japan, and the Netherlands. And something that Europe has in particular that the U.S. does not, dominant consumer luxury brands. So
they do luxury well in Europe.
Like nobody else.
Unfortunately, we got to go, but real quick, indexing or active management for foreign stocks?
So I think when you invest in foreign stocks, indexing is probably the better way to go because you're capturing all this market dynamism and you don't have to worry about the selectivity. I think the diversification is worthwhile.
Andy Kaplan, thanks for your insights. Appreciate it. Barron's polled the biggest money managers on how to invest in this uncertain market, and their answers are next. It's been a rocky month for stocks. All three major indices down since the start of April. Barron's polled more than 100 of America's biggest money managers on how they are deploying cash now. Barron's senior writer, Paul LaMonica, is here with us to discuss. Good story, Paul. Investors certainly have a wall of worry to climb. You've got inflation stubbornly stuck above 2%. Valuations look a little bit stretched. And yet, a month ago, or 6 months ago, I think a third of those polled were optimistic. More than half were bullish this time around. What's the difference?
I think that investors are excited about earnings growth going forward. There is this hope that inflation pressure will start to recede. That should lead to higher consumer spending, higher corporate spending, and you're starting to see a broadening out of this rally. Yes, big tech is still a major contributor of earnings growth and hence the stock market increases that we've had this year. But the money managers are starting to find other opportunities outside of tech.
So now that interest rates have normalized, capital actually has a cost. And so the theory was that you'd move away from tech and into other parts of the market. But you had a great observation from Scott Black, a member of the OG Barron's Roundtable. and he said that if you strip out the Magnificent Seven, first quarter earnings look like they're going to be down 6%. Why would you want to diversify?
Yeah, it is a great point. And it is troubling that so much of the market's dominance is these 7 companies with their strong earnings growth, particularly NVIDIA. But I think the hope is that as the year progresses, you're going to see a widening out and having more companies in other sectors start to participate. And that's why you have the respondents of this poll. They think that earnings growth is going to be 12% for the full year, which is a little bit higher than consensus forecasts. And it's not just tech that's doing it.
So we can't just be long tech. What other areas of the market should I be in?
Yeah, energy is an area where a lot of people are enthusiastic. The hope that oil prices will rise a little bit, whether or not that's more supply issues because of geopolitical conflict or hopefully more about rising demand because the economy is holding up. That's why you're seeing Apache as a top pick of several of our participants, as well as ExxonMobil and Chevron.
Paul, this week was obviously the Federal Reserve's policy meeting, and they were very clear that we're seeing stalled inflation progress. They're probably going to have to hold rates higher for longer. So then, what type of strategy does make sense in this environment?
Yeah, if you're looking at concerns about higher rates for longer, my colleague Ian Salisbury did a story about the barbell approach that you could have for investing, where on one side you want to have cyclical stocks, and then you want to balance that out with more defensive areas like utilities and kind of have bonds in the middle. So on the cyclical side, you can have a company like Mastech. It's an infrastructure construction company getting really more into electricity and renewables. United Rentals, they're a company that rents out things like dump trucks. That's an area that could do well. And Equinix, is another company that could be a sleeper play on AI because it's data centers.
Yeah, and then in that middle, in the bonds, talking about equities being down month to date, you want to give up. What do we do with fixed income given the rate environment? Yeah,
with fixed income, you've got short-term treasuries probably make more sense than longer-term. Duration is what fixed income people keep shouting all about. You've got a corporate bond, intermediate bond ETF from Vanguard that also is shorter duration. And then if you want to take higher risk, you've got senior loans as well, leveraged loans from banks. There's a ticker symbol BKLN that is not Brooklyn, and it's 8% is the yield. So you're getting yield there. With utilities, you also get yield. That's the other end of that barbell that I didn't mention before. You've got companies like Energy and Duke. They're both yielding over 4%. So there are a lot of yield plays in sleepier parts of the market like utilities and bonds.
In 30 seconds before we go, Paul, while this is the smart money we're talking to here, but at the same time, when more people on Wall Street are bullish, that can be a contrarian warning sign. You actually want to buy when nobody's bullish.
Yeah.
Should we worry about this?
I think people are a little worried, but there's also the end quote of the story is that we're climbing the wall of worry. It's cliche, but I think there is a certain grain of truth to it. There's a lot of things for people to be nervous about, but that doesn't mean that the stock market has to go down.
Well, once nobody's nervous anymore, there's no more buyers. So anyway, all right, thanks, guys. Ben has a stock pick next. Megan is going to keep you out of trouble with the IRS. And Al explains auto earnings. Stay right there. Al, 3 cheers for the red, white, and blue. European car makers had a lousy earnings last week, but Ford and GM did pretty well the week before.
Yes, everything you just said is correct. We may want to peel back the flag a little bit because this week we heard from Stellantis, Volkswagen, Mercedes. Sales and margins, not so good. All 3 stocks ended down for the week. Stellantis ended down about 12%. It sort of put a pall over all the car sector. The problem with the analogy is most of Stellantis' problems are in the U.S. Their inventories are too high. And it really is a function of what we learned, again, is the auto market is cyclical, right? So Stellantis outperformed General Motors and Ford by like 50 points. And we like to build narratives. Well, that's about...
It was last year.
Yeah, last year, 2023. And, build narratives, well, it's European, it's the market, it's their hybrid strategy. I mean, what we really learned is some of the 2023 gains are really 2024 pain because now their inventory's on dealer lots. Too many Jeeps.
All righty. Toyota crushing it?
Toyota, same thing, right? Toyota is crushing it. Oh, it's hybrids. Their hybrids are definitely helping. Hybrids are growing faster than battery electric vehicles. Ben and I have talked about this endlessly. Affordability is a huge issue. The average hybrid is $15,000 less than the average battery electric vehicle in the U.S. But if you look at the yen, they make cars in Japan. They export them to the U.S., generally speaking. The yen has depreciated almost all of the operating profit, depending on how you want to count. The improvement in 23 to 24 for Honda and Toyota, yen.
Alrighty, we don't have time for Tesla, but Elon Musk goes to China, and suddenly that stock surges because he got some regulatory help over there. Megan, what if on April 15th I forgot about that second job? Can you help me out?
Well, I think you're not screwed. So this is good news, right? If you or your children or whatever, manage to mess up your taxes this year, you can file an amended return. You actually have a decent amount of time to do it, 2 to 3 years, depending on, circumstances. And, it's interesting because there's this myth that always goes around that if you file an amended return, you're going to get audited. Turns out that's not the case, even though the IRS is cracking down and planning to do more audits this year.
For the record, IRS, I only have one job, and I did declare it. Ben, you have a stock pick for us.
I do. I'm looking at Norwegian Cruise Line, NCLH. They got hammered this week, down 15% after releasing earnings. But the earnings weren't bad. The guidance wasn't bad. Even one analyst came out and said, you do realize they raised guidance and have a record book position, right? They have no idea what's going on. It looks like they might have paled in comparison to some of their competitors. But after that drop, they really do look like they're an interesting place to buy.
I still prefer Andrew Barry's idea of the Viking cruises, but maybe this is a good stock. All right. Thank you, Megan, for saving me there. Thanks, Al. Great ideas from everyone. To read more, check out this week's edition of Barrons.com. And that's all for us. We'll see you next week on Barron's Roundtable.